Today, the silver market didn't trade. It got robbed in public. In 2 sessions, demand for real metal hit the exchange like a battering ram, and the banks started ripping inventory out of each other's hands. That's the event. Physical delivery exploded right as an export wall snapped shut in Asia, and the paper price on your screen stopped telling the truth. Welcome in. I'm your host, and this channel is where we separate the chart from the real-world supply chain. Now watch this. The exchange printed a delivery report that reads like a crime scene photo. One day alone showed 1,168 delivery notices. That's 5. 84 million ounces of silver demanded in a single session. And when we combine it with the surge from the day before, the first 48 hours of 2026 stacked up to 3,446 contracts standing. Each contract is 5,000 ounces. Do the math and feel the weight. That's about 17. 23 million ounces moved in 2 days. Not promised, not netted, not we'll settle in cash. Moved. And here's the part you can't unsee once you see it. The world mines roughly 800 million ounces in a full year. So in 2 holiday sessions, the exchange was leaned on for about 2% of annual global mine supply, before most traders even finished their coffee. That is not normal hedging. A factory doesn't wake up and order 17 million ounces because the boss felt optimistic. This is a run on the vault, and it's happening for a reason. As of this morning, the China export restriction everyone whispered about became real in the supply chain. The East door tightened. The people who actually need metal looked around and realized the easy ounces were sitting in one place. Registered inventory, the for sale pile. So they didn't tiptoe. They kicked the door. Here's the mistake most people make right now. They stare at spot price and think the story is price. It's not. The story is access. The story is who can still get bars when the phone stops ringing. And this report tells us the phones are already going quiet. If we keep seeing deliveries at this speed, the exchange doesn't have months. It has days. That's not hype. That's arithmetic. Now, the delivery number is big, but the bigger signal is intent. Who is forcing metal out? Who is swallowing it? Because this is where the market stops being bulls versus bears and becomes predators versus prey. The suppression era only works when the big players cooperate. They shuffle paper. They swap receipts. They act like rivals on TV and partners in the back room. But this report shows the back room door is open. The cartel truce is cracking. And when a cartel breaks, the theft changes direction. They stop stealing from the public and start stealing from each other. So let's talk about the battlefield inside the data. On a normal day, the big houses pass metal like a hot potato. Bank A issues, Bank B stops, Bank C flips it later. It looks busy, but the bars often stay parked. Today was different. Today metal moved in a straight line, out of one institution's control into another institution's bunker. One major player got forced to bleed, millions of ounces, in one day. And another major player stood there with a bucket and caught the flow. That is not routine. That is survival behavior, and it tells us something ugly. Somebody decided that owning the metal matters more than keeping the peace. So who got hit? The report shows one large European bank delivering roughly 3 million ounces in a single day. That is a serious chunk of inventory to hand over when the supply chain is tightening. And the stoppers? A pair of US giants combined took the lion's share, grabbing roughly 80% of what was offered. Let that sit in your head. 80%. In a market that is supposed to be deep and liquid. We're not watching a crowd, we're watching whales. And when whales start eating each other, we pay attention. Because whales don't do this for entertainment. They do it because they smell a shortage. Now here's the contradiction that should make you lean closer. If the system is so strong, why are banks fighting over bars like it's the last water in the desert? If silver is so plentiful, why are deliveries spiking like a heart monitor? And if everything is fine, why did retail just go dark? Because while the wholesale war is happening in the vault, the street-level market is getting strangled. The little buyer isn't battling a chart. We're battling empty shelves. I've been watching the dealer feeds, and the pattern is brutal. The flagship 1-ounce coin listings are flashing out of stock notices. Not ships in a week, not back order for a couple days. Out of stock with delivery windows pushed way out, weeks, sometimes months. That is not normal seasonal demand. That is a pipeline failure. And it makes sense when we connect one dot to another. Retail coins don't appear by magic. They come from blanks. Blanks come from industrial bars. Industrial bars come from the same pool the big houses are raiding. So when the whales vacuum bars, the mints choke. And when the mints choke, dealers stop promising product they can't replace. That's why you're seeing order books close. This is important. A dealer loves back orders. Back orders are basically an interest-free loan. If a dealer refuses your money, they're not being polite, they're scared. They're telling you, we can't guarantee replacement. And when replacement can't be guaranteed, premiums explode. Not because someone is greedy, because the next bar costs more or doesn't exist. Look at the spread that's forming. Paper says one thing, physical says another. 1-ounce coins are printing prices that are wildly above spot. We're talking double-digit premiums per ounce on mainstream product. And if you want fresh current year coins, even worse. That gap is the market screaming in plain English. The quoted price is not the clearing price, it's a billboard. The real price is what gets metal into your hand. And right now, the handoff is failing. So if you're waiting for a dip, ask yourself this. Dip in what? Dip in a number on a screen? Or dip in the actual availability of metal you can buy? Because a screen can dip while shelves stay empty. That's how shortages look in the early phase. They don't start with fireworks. They start with notify me buttons. Now let's go one layer deeper, because this is where the story turns from annoying to dangerous. We need to watch the vault numbers, not opinions, not vibes, vault numbers. The registered category is the heart of the exchange, because registered metal is the pile that can be delivered. Eligible is a parking lot. Registered is the pantry. And tonight, the pantry shrank. Registered silver reportedly slid to roughly 39, 4 million ounces. In a single day showed a drop of about 8 million ounces. That is not a rounding error. That is a truck convoy. Now connect that to the delivery behavior. If one bank delivered around 3 million ounces and the stoppers absorbed over 4 million ounces, and registered still fell by nearly 3 million, what does that suggest? It suggests the buyer didn't just own the bars. They removed them from the for sale pile. They shoved them into the not for you pile, or they loaded them onto wheels. That's the move that changes everything. Because once bars leave registered, they stop being a pressure release valve for the paper market. They become a locked box. And locked boxes are how shortages go from tight to snapped. Here's the raw implication. If 23 million ounces can stand for delivery in 48 hours, and registered is roughly 39 million, then at this burn rate, the exchange is staring at a couple more bursts before the math becomes impossible. Not hard. Impossible. And while New York is draining, Asia is not sleeping. Shanghai's exchange inventory also reportedly dropped hard on the first session after reopening. A fall of roughly 46 metric tons in a single day. That's about 5 million ounces in one session. Right as the export restriction bites. So the East is drawing down its own stockpile. The West is handing bars over at record pace. And we're supposed to believe nothing has changed? No. What changed is that the global system just started hoarding at the same time. This is the nightmare combo. When everyone hoards, liquidity dies. And when liquidity dies, price doesn't rise smoothly, it jumps, because you can't buy what isn't offered. Now, we have to talk about the psychology trap. People see this and immediately ask, did the big bank blow up? No, we don't need fairy tales, we need risk math. A few million ounces sounds huge, but in dollar terms at current prices, we're talking a few hundred million. That's real money to us. To a mega bank, it's a rounding error. So no, this doesn't bankrupt them. It reveals them. It shows what they fear. They don't fear running out of dollars. They can create dollars. They fear running out of metal. Because metal is the one thing the printer can't make. This is the core shift. They're swapping the printable asset for the unprintable asset. They're doing it in size. And they're doing it at the exact moment the supply chain tightens from both ends. So we need to stop asking the wrong question. The question isn't, will the bank collapse? The question is, what do they know that makes them choose bars over peace? Because if they believed supply was comfortable, they'd keep playing paper games. They'd keep the show going. Instead, they're grabbing lifeboats. And if whales are grabbing lifeboats, we should at least look at the waterline. Now here's where we get surgical. There are only a few takeaways that matter, and we're going to stay focused. First, deliveries at this magnitude are a signal of urgency, not optimism. Second, the issuer stopper split shows concentration, not broad participation. Third, retail shortages and soaring premiums confirm a paper-to-physical divorce. Fourth, vault drains in both New York and Shanghai point to synchronized hoarding. Fifth, the big players aren't broke. They're repositioning into scarce collateral. That's the whole story. Everything else is noise. Now the market will try to distract you with headlines. They'll talk about sentiment. They'll talk about macro. They'll talk about rates. But if you want the truth, you watch one thing. How fast visible inventory disappears. Because visible inventory is the public heartbeat. And right now, that heartbeat is racing. Here's the open loop we need to keep in mind. This was 2 days. What happens when regular trading volume returns? What happens when industrial buyers, sovereign funds, and other banks all decide they want physical too? Because if this level of delivery happened in holiday thin conditions, the next full week could be violent. And that's exactly why we must watch Monday. Not because Monday is magical, because Monday is when the next batch of receipts prints, and receipts don't care about narratives. Now, before we go further, quick and simple, if you want updates the moment the next vault drain hits, subscribe. One click. Stay with us. All right. Let's zoom into the battlefield dynamic, because this is where most people misread the war. When a big buyer takes 80% of the stops, that's not investment demand. That's control. That's someone building a position that does not want to be outbid later. And it may also be defensive. If you're a bank with a giant short exposure somewhere else, owning physical is how you survive a squeeze. You neutralize risk with the only asset that can settle delivery when paper fails. So the whale might be hunting profits, or the whale might be plugging a leak. Either way, the action tells us the same thing. Physical matters more than optics. Now look at the smaller players. If you're a manufacturer, you don't want to pay panic prices later. If you're a refiner, you don't want to be the guy who can't source feedstock. If you're a mint, you don't want to promise coins you can't strike. So everybody tightens their grip. And when everybody tightens their grip, the public gets squeezed. That's why 1 ounce product vanishes first. Not because 1 ounce is important. Because it's the most visible canary. It disappears, and the public panics. That panic pushes premiums higher. Higher premiums pull more metal from wherever it can be found. And that accelerates the drain. It's a feedback loop, a pressure cooker. And the lid is the registered category. Now let me ask you something that should bother you. If a few million ounces can change the mood of the entire system, what does that say about the real cushion? What does it say about the deep inventory that's always advertised? And what happens if the next delivery burst is not 17 million ounces, but 25? Because the export wall just started. The supply chain doesn't heal overnight. It constricts. So we should assume pressure, not relief. Now, a lot of people will say, but they can always cash settle. Sure, they can try. But cash settlement is an admission. It's the casino saying, we don't have chips, take dollars. That's when confidence cracks. That's when every participant asks, if they paid him in cash, will they pay me in cash too? And that's when the stampede begins. So the system has one job: keep physical flowing enough to avoid that moment. This is why the vault numbers matter more than the chart. Because the vault numbers tell us how close we are to the chips are gone moment. One more twist. When physical spreads widen, arbitrage becomes the hammer. Traders buy the cheap paper venue and sell the expensive physical venue, and that pressure snaps the screen price upward. It's not bullish sentiment. It's plumbing. If Shanghai stays bid while New York prints discounts, the gap becomes free money, and free money attracts sharks. That's why smashes don't last when the East pays up and forces shorts to scramble and make Monday's open feel violent. Will the gap reopen Monday night? Now let's get real about strategy without pretending we can predict the next tick. This is educational. We manage risk. We don't gamble. So what do we do with this information? We stop being hypnotized by paper. We watch spreads, we watch premiums, we watch delivery reports, and we watch whether registered keeps shrinking even after the delivery window passes. Because if registered keeps draining, it means the metal is being hidden, not recycled back into liquidity. And that is how shortages become permanent. Now, I want you to hold one image in your mind. Picture the exchange as a water tower feeding a city. Registered is the water level. Paper contracts are faucets. For decades, they've opened faucets and claimed the tower is full. But today, we saw the tower level drop in public. And when a city sees the water level falling, the city starts filling bathtubs. That's hoarding. That's what this looks like. And once people start filling bathtubs, the pressure falls faster. This is why the retail market is the emotional accelerant. Now, 2 quick questions for you, because I want to hear how you're reading this. If the screen price is calm but premiums are exploding, which one do you trust? And if banks are grabbing physical while telling the public nothing to see here, what does that tell us about their real view of supply? Drop your answers in the comments. We'll read them. Now, here's the final open loop as we step into Monday. We just watched a major bank deliver millions of ounces. We watched US giants swallow most of it. We watched registered drop. We watched Shanghai drain. The only way this calms down is if metal flows back into registered. Not words, not speeches, metal. So Monday's question is simple. Do we see replenishment or do we see another drain? Because if we see another drain, the market isn't tight, it's breaking. And if it starts breaking, the next move won't be a gentle uptrend. It'll be a gap, a lurch, a price jump that happens while you're asleep, when Asia opens and the ARB desks smell blood. And the craziest part? The paper price can still be pushed down in the middle of that, just to shake weak hands. That's the psychological warfare. They slam the screen to scare you while they load trucks behind the curtain. So our job is to keep our eyes on what they can't fake. Inventory, delivery, premiums, and bank behavior. We are not spectators. We're observers of a supply chain war. All right, we've got one more report coming, and when it prints, we'll know whether this was a 2-day anomaly or the opening salvo of a year-long bank war. If the next delivery wave hits and registered doesn't refill, we're going to see something the modern market hasn't seen in decades. A genuine no-offer moment. Not a meme, a real shortage. So stay close, hit subscribe, and be here when the next receipt drops. Because that is when this story stops being theory and becomes price discovery in the real world.